Hi, my name is Joshua Gia, and today we'll be talking about leveraged buyouts. Leveraged buyouts are acquisitions used primarily debt, and they're done by private equity companies seeking to amplify their returns. We'll talk a bit both about how debt amplifies returns, but also how the exit multiple can as well.
First, I'll discuss a bit about Finance Interview Coach. We provide interview coaching for investment banking and private equity, and we focus especially on the advanced technical questions and case studies that you might expect. We're also working on a video series, which this is a preview of, and we're also working on a textbook with hundreds of questions and answers. So without further ado, I'd like to discuss leveraged buyouts. As mentioned, we use a large amount of debt to boost returns, and we essentially sell the company after 5 years. This is what private equity firms often do, and they use about 40 to 70% of the consideration as debt. So what does that mean? Well, debt is a way of increasing returns. So in this example, for example, we start with $100 that we're essentially paying to buy a company. And if we sell that company in 5 years for $200, you will have earned a 15% IRR. Now, what is IRR? It's the internal rate of return. It essentially represents, in this scenario, the compounded annual growth rate. Now, what if we added 50% debt? In that case, in year zero, you're actually only using $50 of equity to buy the company, and you're going to borrow the other 50. So in other words, you achieve the same result while still putting less equity initially. And as a result, that 50 of equity grows to 150 of equity, which is essentially the $200 that you sell the company for, less the debt of 50 that you borrowed initially. So you've tripled your money now at a 25% IRR over 5 years. In other words, the more debt you have, the less initial equity you have to invest, and therefore the higher your returns and your IRR. Now, there are multiple ways of driving returns in a leveraged buyout. One example would be, for example, paying off debt over time. As you can see here, we start with $100 of debt in year zero, and over time, we pay it all off by year 5. What does this mean? Well, when you're paying off debt, that means you're actually increasing the equity ownership percentage in the company. So for example, in this scenario, we actually start with 50% debt and 50% equity in year zero. In the next year, because we paid down $20 of debt, we're now at 40% debt and 60% equity. And it goes and goes and so on until you pay off all the debt in year 5 and you actually own 100% of the company. Well, what does this look like? Well, as you can see in year zero, we spend $100 to acquire the company, and we also borrow $100. Now, even if we sold that company for the exact same price, which is $200 in year 5, but if we just pay down the debt, then we own 100% of the company. Therefore, we've doubled our money essentially from 100 of equity that we first put in, now to 200 of equity, since we own 100% of the company. There are other ways to drive returns in a leveraged buyout as well. For example, if debt was flat, your ownership percentage would not change. However, what if you as a private equity firm made the company a lot more profitable? You made its prospects improve, either by improving its operations or entering a new market or just cleaning up the business. Well, you would actually potentially sell the company for a higher price, a higher multiple of EBITDA potentially. So what does that mean? Well, for example, if we acquire a company for $200 million, 50% equity, 50% debt, but then we improve the business and we sell it for $400 million, even at the same ownership percentage, that's another way to double your money.